The financial performance of B2Gold in 2025 established a high watermark for the company, providing the capital necessary to fund the final stages of its current organic growth phase. The company reported record annual revenue of $3.06 billion, a 58% increase over the $1.93 billion generated in 2024. This top-line surge was the result of a dual-track success, steady production performance across the legacy portfolio, and the first contributions from the Goose mine, which poured its first gold in June 2025. Consolidated gold production for 2025 reached 979,604 ounces, meeting the company's guidance and reflecting strong output from the Fekola, Masbate, and Otjikoto mines. Financially, the company realized an average gold price of $3,299 per ounce, resulting in an adjusted attributable net income of $612 million, or 46 cents per share.
The company reporting annual consolidated cash operating costs of $769 per ounce was particularly notable given the inflationary headwinds facing the broader materials sector. These figures were aided by higher-than-expected production and lower fuel expenses in the first half of the year, providing a robust margin cushion as the company transitioned into the more capital-intensive 2026 period. 2026 operational guidance, the bridge to steady-state growth. The company's guidance for 2026 reflects a transitional year, as B2Gold navigates the ramp-up of the Goose mine and the depletion of certain open-pit reserves at its legacy sites. Consolidated gold production for 2026 is anticipated to be between 820,000 and 970,000 ounces.
This projected year-over-year decrease is primarily driven by three factors: a step-down in production at the Otjikoto mine following the completion of open-pit mining in the Otjikoto pit, lower production at the Fekola complex due to major stripping activities in Phase 8 of the Fekola pit, and the timing of the transition to steady-state operations at the Goose mine. Perhaps the most scrutinized aspect of the 2026 guidance is the projected increase in all-in sustaining costs, or AISC, which are expected to range between $2,400 and $2,580 per gold ounce sold. This figure is an escalation from the 2025 AISC of $1,584 per ounce. Analysis of the cost components reveals that this rise is not merely a reflection of operational inefficiency, but rather a direct consequence of the high gold price regime. Royalties and production taxes are expected to account for approximately $525 per ounce sold in 2026, calculated on an assumed gold price of $5,000 per ounce. Furthermore, consolidated cash operating costs are guided at $1,155 to $1,280 per ounce, reflecting persistent input cost inflation for labor, reagents, and fuel, as well as the higher cost nature of the Arctic operations.
The Goose mine and the Back River District. The Goose mine in Nunavut represents the most significant addition to B2Gold's portfolio since the acquisition of Fekola. Achieving commercial production on October 2, 2025, the mine has quickly become a focal point for investors seeking exposure to Tier 1 jurisdictional growth. In the 30 days leading up to the declaration of commercial production, the Goose mill achieved an average throughput of 2,652 tons per day, representing 66% of its design capacity of 4,000 tons per day. By the end of 2025, throughput had increased to over 80%, with the mine expected to reach its full nameplate capacity in early 2026. The strategic importance of the Goose mine extends beyond its immediate production profile. It serves as the inaugural asset in the Back River Gold District, an 80-kilometer belt of claims that B2Gold manages with 100% ownership.
The district is characterized by high-grade mineral reserves, with the Goose mine itself boasting an average grade of 5.97 grams per ton gold. Management expects the mine to produce between 170,000 and 230,000 ounces in 2026, with output projected to exceed 300,000 ounces annually starting in 2027 and continuing for at least 6 years based on existing reserves. However, the Arctic setting introduces a unique set of operational risks and logistical costs. The mine is a landlocked asset for most of the year, dependent on a 163-kilometer winter ice road, or WIR, that is constructed annually between February and May. This road is the only conduit for transporting the millions of liters of diesel fuel and thousands of tons of dry cargo required to sustain operations.
During the 2024 sea lift, 10 ships and 1 barge unloaded 123,000 cubic meters of cargo and over 84 million liters of fuel at the Marine Laydown Area, MLA, in Bathurst Inlet. The fragility of this supply chain, highly sensitive to climate variations, remains a persistent overhang on the mine's cost profile. To mitigate early throughput limitations, the company has implemented supplemental mobile crushing capacity and is currently engineering permanent optimizations to the primary crushing and secondary grinding circuits, including the potential installation of a SAG mill. Exploration upside in the Back River Gold District. B2Gold has aggressively pursued exploration across the district to extend the life of the Goose mine and identify satellite targets. The 2025 exploration program, which saw $32 million in spend and over 28,000 meters of drilling, delivered significant high-grade results.
Drill hole 25GSE702 at the Llama deposit returned 41.95 grams per T gold over 13.70 meters, while results at the Nuvoyak deposit confirmed the continuity of high-grade zones approximately 150 meters to the north-northwest. For 2026, the exploration budget has been increased to $46 million, focusing on resource reclassification and testing new regional targets identified during the 2024 summer program. The Fekola complex, navigating Mali's regulatory evolution. While the Goose mine provides geographic diversification, the Fekola complex in Mali remains the company's primary cash flow generator. Fekola's importance to the national economy cannot be overstated. It is the second largest gold mine in Mali and a major source of foreign exchange. In 2025, Fekola generated $1.74 billion in revenue, up 83% year-on-year, driven by a 35% increase in production to 530,769 ounces and elevated gold prices.
The implementation of Mali's 2023 mining code has introduced a new layer of complexity to the operation. The revised framework increases the state's non-dilutable participation in mining projects from 20% to a minimum of 35%. While B2Gold maintains an 80-20 split with the government at the main Fekola mine, the new deposits grouped under Fekola Regional operate under a 65-35 equity structure. Furthermore, royalty rates have increased from 6.5% to 10%, a change that contributed to B2Gold declaring $277.9 million in royalties and taxes at Fekola in 2025, compared to $100.3 million in 2024. Operational stability at Fekola has remained intact throughout this regulatory transition. As of November 2025, the company reported that milling and mining activities were operating at full capacity and all permits were in good standing. The company anticipates receiving the exploitation permit for Fekola Regional in the first quarter of 2026, which will allow for the trucking of higher-grade ore to the Fekola mill. Fekola Regional is expected to contribute between 60,000 and 80,000 ounces in 2026 and reach an average annual production of 180,000 ounces over its first 5 years of operation. This expansion is critical to offsetting the planned lower production from the main Fekola pit as it enters a stripping phase for Phase 8. Bull case analysis. The bull case for B2Gold is predicated on the company's transition into a more resilient, diversified producer that is fundamentally undervalued relative to its Tier 1 growth potential and cash flow generation.
Tier 1 jurisdictional diversification and de-risking. The primary catalyst for a re-rating of BTG shares is the successful commissioning and ramp-up of the Goose mine. For years, B2Gold traded at a discount to peers like Agnico Eagle or Alamos Gold due to its jurisdictional concentration in West Africa. The establishment of a major production hub in Canada fundamentally alters this risk profile. By 2027, B2Gold is projected to derive over 300,000 ounces of annual production from a stable rule-of-law jurisdiction. This Canadian hedge provides institutional investors with a more palatable entry point, potentially leading to an expansion of the company's PNAV and EV to EBITDA multiples toward the higher end of the mid-tier peer group.
Exceptional operational leverage to spot gold. B2Gold is one of the most leveraged producers to the gold price among its peers. With a significant portion of its production coming from high-grade assets like Goose and Fekola, the company's margin expansion in a $5,000-plus gold environment is profound. While the 2026 AISC guidance is high, a significant portion of that cost is variable in the form of royalties and production taxes that only escalate when revenue does. This means that the company's free cash flow generation is highly protected. At a spot price of $5,600, a producer with a 2,500 AISC is still generating over $3,000 per ounce in operating margin. B2Gold's ability to generate record free cash flow, as seen in the $215 million record set in Q4 2025, is expected to accelerate as the Goose mine moves past its initial capital-intensive ramp-up and the Fekola regional high-grade ore enters the mill. Growth pipeline and reserve replacement. Beyond the current production profile, B2Gold possesses a robust organic growth pipeline that is often overlooked. The company owns 100% of the Gramalote Gold Project in Colombia, which is being evaluated for potential development as a large-scale open-pit mine. Additionally, the transition to underground mining at the Otjikoto mine, the Antelope deposit, and the approval to commence underground mining at Fekola suggests that the company is effectively extending the life of its core assets. The aggressive $46 million exploration budget for 2026 is a signal of management's intent to maintain a reserve replacement ratio that exceeds the industry average, which is currently struggling in the great supply squeeze.
Superior shareholder return framework. B2Gold has maintained its status as a premier dividend-paying mining company, having distributed approximately $870 million to shareholders since 2020. The current quarterly dividend of $0.02, $0.08 annualized, provides a yield of approximately 1.9% to 3.3%, depending on market fluctuations, which is significantly higher than larger producers like Newmont or Kinross. The company's commitment to shareholder returns is further evidenced by its normal course issuer bid, NCIB, which allows for the repurchase of up to 5% of its common shares. This dual return strategy, dividends plus buybacks, is a foundational element of the company's capital allocation philosophy, attracting value-oriented investors who seek income alongside gold price exposure.
Satisfaction of the gold prepayment obligation. A looming catalyst for the bull case is the expiry of the company's gold prepayment obligations. In 2025 and early 2026, B2Gold's revenues were partially constrained by a debt instrument that required the delivery of gold at a capped price, estimated by some analysts to be around $2,000 per ounce. In Q4 2025 alone, over 66,000 ounces were delivered under these obligations. As these obligations are satisfied, expected by mid-2026, the company will be able to sell 100% of its production at prevailing spot prices. This transition will provide an immediate and material boost to quarterly revenues and earnings per share, potentially serving as the trigger for the next leg of the stock's rally. Bear case analysis. The bear case for B2Gold focuses on the structural risks of its operating environment, the technical complexity of its growth projects, and the inflationary pressures threatening its long-term profitability. Deepening geopolitical risk in West Africa. Mali remains the Achilles heel of the B2Gold investment thesis. Despite the company's success in navigating the 2023 mining code, the broader trend of resource nationalism in the Sahel region is a persistent threat. The increase in the state's stake to 35% in new projects like Fekola Regional is a clear indicator that host governments are demanding a larger share of the mining sector's wealth. Furthermore, Mali faces significant security challenges, with armed groups continuing to threaten stability in various regions. Any escalation in regional conflict could disrupt the supply of critical mining consumables or force the suspension of operations. The fact that the Fekola complex represents over 50% of the company's operating net asset value, NAV, creates a concentration risk that many institutional investors find unacceptable, regardless of the gold price. Any regulatory conflict or security incident in Mali would have a disproportionate impact on B2Gold shares compared to more geographically balanced peers. Technical hurdles and Arctic operational sensitivity. The Goose mine, while a strategic asset, is an operational high-wire act. The reliance on the annual winter ice road, or WIR, introduces a level of logistical fragility that is rare in the industry. Should a warmer-than-average winter shorten the WIR transportation window, the mine could face critical shortages of Arctic-grade diesel fuel or heavy equipment parts, leading to production shortfalls or emergency air freight costs that would decimate margins. Moreover, the initial ramp-up at Goose has already seen technical challenges, such as the crushing plant capacity shortfall in late 2025 that forced a reduction in production guidance from 120,000 to 150,000 ounces to 80,000 to 110,000 ounces. The need for supplemental mobile crushing capacity and permanent engineering optimizations, such as the installation of surge bins and potential SAG mill additions, highlights the risk of capital expenditure creep in remote Arctic environments. If these optimizations do not deliver the expected throughput, the mine may struggle to reach its target production of 300,000 ounces per year, rendering it a lower return asset than originally modeled.
Margin compression and the inflationary AISC ceiling. The 2026 AISC guidance of $2,400 to $2,580 per ounce is a stark warning that B2Gold is not immune to the inflationary pressures plaguing the materials sector. While royalties account for a large portion of this cost, the controllable costs are also rising. Input cost inflation for fuel, labor, and reagents is a persistent challenge, and the company's production cost per ounce has risen significantly over the last 2 years. In a scenario where gold prices retreat, perhaps due to a hawkish Federal Reserve or a resolution of geopolitical tensions, B2Gold's high cost base would leave it with significantly thinner margins than its lower cost rivals. The company's guided 2026 cash operating costs of $1,610 to $1,810 per ounce for the Goose mine are among the highest in the mid-tier segment. This high break-even point makes the asset highly sensitive to any price correction, potentially forcing management to rethink its capital return strategy to preserve liquidity.
Leadership succession and integration risk. The retirement of Clive Johnson in June 2026 represents the loss of a founder who has been the driving force behind B2Gold's culture and strategy for nearly 2 decades. Johnson is widely viewed as a deal-maker with a unique ability to navigate difficult jurisdictions. While Mike Cinnamond is an experienced CFO, the transition from a founder-led company to a more traditional corporate structure can be fraught with execution risks. The new leadership team will immediately face the dual challenge of optimizing the Goose mine and managing the Fekola underground transition, all while maintaining the company's disciplined capital allocation in a high-cost environment. Any perception of a vacuum in strategic vision or a decline in operational agility following Johnson's departure could lead to a discount in the stock's valuation as the market adopts a wait-and-see approach.
Balance sheet leverage and capital intensity. While B2Gold's debt levels are currently manageable, the company has seen its debt-to-equity ratio rise from 3% to 15% over the past 5 years as it funded the Goose construction. As of December 2025, the company had $546 million in total debt. The need to draw $350 million from its revolving credit facility, RCF, to cover distributions and capital expenditures has raised some concerns about liquidity if cash flow generation from the new assets is slower than expected. If the Goose mine requires further growth capital for optimizations beyond the $120 million already guided for 2026, the company's ability to maintain its NCIB and high dividend yield may be tested. Financial architecture and capital management. As of early 2026, B2Gold maintains a robust financial position, characterized by high liquidity and a structured approach to debt and shareholder returns. The company ended 2025 with $380 million in cash and cash equivalents, providing a solid buffer for the final stages of the Goose mine ramp-up.
The company's $800 million revolving credit facility, RCF, is a key pillar of its financial flexibility. In 2025, the company first repaid an outstanding balance of $400 million on the RCF, then drew down $200 million in the third quarter of 2025. By late 2025, the company had repaid another $50 million, and a further $100 million was repaid subsequent to year-end, leaving $750 million available for future draws. This high level of available credit ensures that the company can navigate unforeseen operational hurdles or capital calls without needing to return to the equity markets. The company's capital structure is also influenced by its derivative instruments and gold stream obligations. For the year ended December 31, 2025, B2Gold reported a loss on derivative instruments of $266.79 million and a change in the fair value of its gold stream of $118.36 million. These figures are primarily a result of rising gold price affecting the mark-to-market value of the company's prepayment and hedging arrangements. While these non-cash losses impact GAAP earnings, they do not detract from the underlying cash flow generation of the operating mines.
Competitive landscape and peer benchmarking. In the mid-tier gold mining segment, B2Gold competes for capital with several high-quality producers, most notably Kinross Gold, Alamos Gold, and Equinox Gold. Each of these companies offers a different trade-off between growth, jurisdictional risk, and dividend yield. B2Gold versus Kinross Gold. Kinross has successfully reinvented itself as an Americas-focused producer after exiting its Russian operations in 2022. Kinross trades at a modest premium to B2Gold, with a forward PE of 13.5x compared to B2Gold's 10.2x.
While Kinross has a strong production profile and the massive Great Bear project in its pipeline, B2Gold offers a superior dividend yield, 3.3% versus 0.4%, and higher immediate leverage to the gold price due to its high-grade Arctic and African assets.
B2Gold versus Alamos Gold. Alamos is often considered the gold standard of mid-tier producers due to its 100% Tier 1 jurisdictional focus and debt-free balance sheet. Alamos trades at a significant premium with a P to NAV of 1.30x compared to B2Gold's 0.91x. While Alamos is a lower risk investment, B2Gold provides significantly more asymmetric upside potential if the Goose mine delivers on its 300,000-ounce target and the Mali regulatory environment stabilizes. B2Gold versus Equinox Gold. Equinox is a high-growth producer with a 100% Americas footprint. Equinox projects 760,000 to 840,000 ounces in 2025, positioning it as a direct peer to B2Gold in terms of scale. However, Equinox carries higher net debt and has historically faced more pressure on its valuation due to operational diversification trade-offs. B2Gold's established cash flow from Fekola provides a level of financial stability that Equinox is still working to achieve as it ramps up its Greenstone project.
Conclusion. B2Gold enters 2026 as a significantly more geographically balanced company than it was a decade ago. The renaissance of the company is defined by its entry into the Canadian mining landscape, a move that provides both a critical hedge against West African jurisdictional risk and a platform for multi-decade growth in the Back River Gold District. The bull case for the stock is centered on the re-rating potential as the Goose mine achieves steady-state production and the Malian regulatory environment settles into a predictable, albeit more expensive, framework. The leverage of B2Gold to the $5,000 plus gold price regime is exceptional, and the upcoming satisfaction of its gold prepayment obligations will unlock significant incremental revenue in the second half of 2026. Furthermore, the aggressive exploration program and robust growth pipeline suggest that B2Gold is better positioned than many of its peers to thrive in an era of global gold scarcity. Conversely, the bear case is anchored in the undeniable risks of operating in high geopolitical regions and the technical fragility of Arctic mining. The Mali discount is likely to persist as long as the 2023 mining code remains in its implementation phase and security concerns linger in the Sahel. Additionally, the historic AISC guidance for 2026 highlights the vulnerability of the company's margins to persistent input cost inflation. The leadership transition in June 2026 adds a layer of uncertainty, as the new executive team must prove it can maintain the Clive Johnson-era growth while instilling a more finance-focused discipline.